I'm Jeremiah Boucher, a commercial real estate investor with over 20 years experience. This show is designed to help you build your business, become a better real estate investor, and help you see opportunities that will keep you ahead of the competition. This is Finding Your Edge. How do you really make money in real estate? This is Jeremiah Boucher, Finding Your Edge podcast, and today I want to talk about the truth about real estate investing. There's so many gurus out there sharing that you can make easy money in real estate, no money down. You can make millions of dollars right out of the gate, and it's just not realistic, right? You can lose money in real estate, believe it or not, and a lot of people have over time. Everyone says real estate is location, 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 but real estate is also timing, timing, timing. And what I've learned over 20 years of investing in commercial real estate, residential real estate, pretty much all asset classes from retail, office, industrial, apartments, mobile home parks, self-storage, car washes, bars, anything else you could think of. I've been doing it. So I wanted to share in this episode, what is the truth about real estate investing and what are you committed to in real estate investing? There's a couple of different paths to go. I think a lot of people get confused that they think they can jump right into advanced commercial real estate investing without having any experience, that there's good deals out there, that they're going to be able to invest in and typically compete with some of the best people that are out there raising money, acquiring deals, focusing on one asset class. And it's just not really realistic. When I started out in real estate, it was in residential housing, one house at a time. And I got my butt handed to me in the 2008 crash, losing it all, and then figuring out what am I going to do from here. But the whole point was I did not have an edge. And that's why I call this show Finding Your Edge, because the goal as a passive investor, as a active investor, is to have that competitive advantage, right? In sports, you have to have something, some skill. Your team has to have some edge or advantage or competitive differentiator that's going to cause you to win over time. And everybody has something different. So for me, it is looking at where can I find a asset class or a market that doesn't have everyone else invested in it. And I want to do something first. If I could be somewhat of a first mover, then I can create an advantage and I can drive higher returns. Because if I invest with just the herd, then I have no edge. And this goes for being a limited partner as well. When I've looked at other people's partnerships, I want to know, where do you have the advantage when you're buying the asset class? Where do you have the advantage when buying the apartment complex, the office, the industrial? Are you great at managing? Can you build for a cheap price? Do you know the market in and out? And there's this anomaly where there's a gap over here where there's no supply and there's a ton of demand. So these are the things we want to look at. And the reality in real estate is it is a long, long game, right? We play long-term games with long-term people. That's what I want to focus on. And if you think you're going to find a quick flip piece of real estate, you can do that. That is a very normal business model, yet it can catch you on the downswing and you can get hurt badly by it. Because remember, typically you're leveraging these properties. You're getting debt on them. And then in turn, you have to service that debt. And if the market goes south and you can't cash flow, that's a hard road to dig yourself out of. Now, what I've learned also is that if you have enough cash or capital and you have enough time, typically 99.9% of the time in real estate, you're going to win, right? Inflation will win. There will be an inflating, the economy will continue to inflate and rents will go up. There will be some demand for your product as long as you are in a populated area where people live and work. You can get out of it, but do you have the bankroll to withstand the bad times? And that's where the opportunity rises, is in the bad times when other people don't have cash and you have access to cash, or you have the knowledge and insight to be able to use other people's cash or create deal structures that are creative, then you're able to acquire assets at a great price or with great terms or both when the market is going in the other direction because there's less competition. And that's where your competitive edge is hyper accelerated. So looking at it from a active investor, a full-time investor. Like, what's realistic for a person working 40 to 80 hours a week? How are they going to truly find great deals? And how are they going to manage those deals? Well, the reality is you don't have to find an unbelievable deal. Yes, you can market like we do at my firm and many of these investment firms that are buying real estate, where you have you're cold calling, you're mailing, you are sending text messages and voicemails, and you're out there actively trying to find great deals. If you're a residential or a commercial investor and your full-time job is taking you away from that, it's really about just focusing on one area, focusing on one type of property class, and just continually learning and looking at what comes up. And there will be market cycles, and it may not be a screaming deal, but if you can get the deal at a decent basis, it cash flows, and you can install third-party management, some property manager there, then you can be patient. Let your property, the asset itself grow over time. But you really have to have a 10-year horizon on this if you're thinking about growing substantial wealth. Because if you're paying fair market prices and you're having the fees and costs of a third-party manager managing the asset, and if you are needing to reinvest in that property and make some improvements and buffer for cash flow, for lack of cash flow, you need to buffer for actually maybe a bad situation occurring and you need to fund more of that deal because the cash isn't available in the asset. Like, these are things that you need to be aware of and have the right expectations, right? Double the timeline, double the cost, and think of it, am I still willing to invest in this property? And most people start out with single family homes, then you go into commercial assets like apartments, smaller apartments, then you graduate into mobile home parks and self-storage and traditional assets like retail. I wouldn't do office. You got to have really, really thick skin to be able to get in the office game right now. It is doing very poorly, but also large apartment complexes, industrial buildings. Those are all traditional retail asset classes. What's the competitive edge, though? That's the key. And it's hard. It's hard to find good deals. And you have to risk your own credit. And you have to be able to have that extra cash available. And you have to be patient. If you don't do that, then it's not realistic and you're going to be disappointed and frustrated by the process. Plus, it does take time and energy. At the end of the day, real estate is a business, period. You have to focus on it and manage it like any other business. Now, it might not require as much time, but you still requires focus. The other option, passive investing. That is investing in another general partner, a lead partner. They're called syndicators or fund managers, whoever it is, that they're the quarterback. They're the lead on the actual transaction. And that's where you have to, as a business owner or entrepreneur, do what you hate the most to do, is give up control, right? That's not hard for me. It's not hard for any other successful business owner. And that's where we wonder, how do we trust this person? How do I know I'm going to make money on this asset? And you don't know, right? At the end of the day, there's a million different metrics and interest rates going up and down, economies falling and rising, industries that are more popular than others, areas that are growing, areas that are shrinking, pandemics that hit. These are all situations that no one can control. So the only thing that you can really control is investing in the person that you choose to invest with. You can't control that person, but you can choose who you invest with. And I always like to say the jockey is more important than the horse, betting on the jockey, right? Because that's the leader. That's the one that's going to be committed to the deal, and they can ruin an investment or they can make an investment. But typically you can't find an asset that will run on its own. You need somebody leading the front, actually driving the whole process. And when doing that, I look at, okay, how do I pick the right person? Well, number one, they have to find good deals. They have to have access to deal flow. If there's not great deals, then they're not adding any value. So a question I would always ask is, where did you find the deal? How do you find your deals? How do you evaluate the deals, and why? Why do you like this property? Why do you like this area? And it's really listening to conservative assumptions. And if you're not in the industry, it's hard to figure out what's conservative and what's too aggressive. How do you know? And that's where you get a professional, right? Someone like me or anyone in the commercial real estate world that doesn't have an interest in the transaction to look at it and say, okay, this is a solid deal because because there's consistent tenants and there's high demand and there's a low interest rate and you're buying it at a good basis, right? And there's potential for growth. People are moving to this area and rents are going up over time, or housing is expensive and there's a need for affordable housing or storage. So these are things to look at when you are investing in a particular person. But more importantly, with that person is you want to know how much skin in the game do you have, right? I love investing with other people that are all in, all in. Their credit's on the line, their cash is on the line, and they have something to lose. In the very beginning, if you have nothing to lose, that's another story. Even then, though, it's nice when they have something in it, but real cash in the deal. So if the sponsor has a significant amount of money, and whatever that is relative to their current situation, even if it's $100,000, if that's a lot of money to them, that's a great indicator they are going to be committed to this deal. And they're going to be vested. They want to make money alongside you. Second thing is, if their credit is on the line, they are going to do whatever it takes not to lose that property. Now, it might take a longer period of time for you to get your equity back or make money on that equity, but they're going to fight like hell not to lose the property. And I want that. I want them all in. Next thing is, are they focused? How many different businesses are they running? What ideas are they working on? What projects are they working on? This is a focus check. Are they truly focused on this asset or this business, this asset class? And they can have multiple properties, but are they focused on this business plan where they have, the next thing is a team. So if they have a handful of apartment complexes or vacation rentals or storage facilities, do they have a team? And I always ask them, who's on your team and why did you choose the people on your team? Because if there isn't a good team, no matter how good their ideas are, their energy, their entrepreneurial spirit and passion, they're not going to be able to execute. Doesn't work that way in real estate. Real estate is a team sport. So their team is critical, knowing that. And once you see what that team can do, you got to look at the product, right? What are the product types that you own in terms of how's the website, how's the marketing, how's the quality of the property? It doesn't need to be A-class or perfect and prestige, but it needs to serve the customer, because the way that any investment, good, solid investment works is smart people have to build useful things or create useful things. And that's what attracts capital. That's what attracts revenue. And this is what the beauty of capitalism is. So if you have these things lined up, we have a strong sponsor with a good asset and they're dedicated to the asset. They got skin in the game. They have a team. They're focused and they're driving through this process. Then you want to ask them, tell me about your failures. Tell me about when something went wrong on a property or in your company. And if they don't have any failures or they're not willing to admit them, that's a problem. Because the worst thing that can happen is you give someone money that won't admit to their mistakes, they won't handle them, they won't step up and follow through, and they try to hide it. And that's the worst thing as an investor when you have no communication from someone. Not everything's going to work out, but is that person committed? And if they are they willing to be brave enough to share? These are the problems. This is how I'm going to remedy those problems. This is where we're trying to go. This is the target that we need to get to in order to all make money. And it's very simple. It's communication. It's not overcomplicated, right? It's just knowing you can trust somebody. They have integrity. They have character. They're going to follow through. And they are committed to making this thing work. And they're going to ride the waves. There's going to be good waves and bad waves. And sticking with the process. And communication. That is so important in every relationship, right? If you have a wife or husband, communication. If that goes poor, the whole relationship gets really bad really quickly. And it's the same thing in a partnership. So asking yourself the questions, do you truly have time and energy to go out and find your own assets? That's hard. And if you don't have the time to do it, then how are you wanting to invest in real estate? Is it looking at a partner? Do you bring in or do you invest in a reputable fund? Or do you look at a very hands-off passive asset like a triple net property, like a McDonald's on a master lease, or a Walgreens, or a Pizza Hut, or Dunkin' Donuts? Like, these assets take very little management, but there's not good returns. these type of retail deals, they call them triple net retail deals, typically trade at low cap rates, meaning there's a very low rate of return on these assets because all investors love having a credit tenant, a very, very successful business that occupies the space, paying on a long-term lease, and they don't have to manage it. But the downside of that is if the tenant doesn't renew, that is one source of income. If you lose that source of income, no matter how much cash flow you made along the lease for 5 or 7 years or 10 years, is you better have something left over because not every tenant wants to refill a Dunkin' Donuts building. You're going to have to do some major improvements to find the next tenant to move in there. So it's a pro and con having single tenant, easy management buildings. There's a pro there, but there's a con there. And then multi-tenant buildings like storage, like apartments, like mobile home parks, like industrial parks, they're great where you have diversified streams of income. You have multiple tenants paying multiple rents at multiple times with different leases. And that's very, very consistent because you have lots of tenants. But on the downside is you have lots of tenants, a lot of people to deal with, a lot of problems, a lot of maintenance, a lot of hand-holding and marketing to get those properties managed. Now, if you have tens of millions of dollars, then yes, you go out and buy your own apartment complex, buy a big one, 150, 200 units, hire a professional company. They do all the management. You get a check, and ideally you have someone overseeing them, making sure they do their job. If you're a smaller investor and you're looking at assets under $10 million, there's not a lot of assets out there that you can just hire somebody to go manage it and it's all smooth sailing. There's going to be time and energy to focus on those assets. So it's just a question you have to ask yourself. And the key is, what am I trying to achieve? What is the goal that I want to create with my real estate holdings? Now, if you want truly passive investments and you don't want to find any partners or deal with anything, you go invest with the herd, right? You buy stocks and you just sit there on it for years, and over a 10-year period of time, you're going to make out. The stock market goes up over a long period of time. Or if you buy fixed income, you put your money in a money market account and you get 4% right now in 2025, and you get income. Or you put your money in gold or silver or Bitcoin or whatever it is. You don't have to do anything there. Yet you're missing out on some key pieces of getting a great return on your investment. And the biggest key is tax deferred returns. All these other vehicles, you do not have the ability to offset your tax. It's very difficult unless you're doing a special investment product. All the traditional assets are not tax advantaged. So every year, if you're receiving dividends or distributions, you are getting taxed at ordinary income, whatever your tax bracket is. And this includes if you are in a money market account or if you're lending money to people. All of those forms of income, typically portfolio or ordinary income or income coming in from your business, is taxed at ordinary income. And that's 37% right now, plus your state tax, which in California is 13%. That's 50% of your net earnings is taxed. And in real estate, there are ways to offset that cash flow where you get losses. And we can get into that in another video, but along the ownership period of that real estate, if you structure it correctly, you do not pay tax along the way. You are deferring it. So each year of cash flow for 10 years, you defer paying tax due to the losses that property allow you to take. And you can still take that money and spend it and reinvest it any way you want. And you can refinance the building after your value has been created and pull all your money out that you invested in. It is the most beautiful thing in commercial real estate or any real estate investing. Infinite returns, right? Some people call it the BRRRR method. Buy, rehab, refinance, repeat. Like that is the best strategy you have out there. But it's patience. This can take a decade. That's the problem with most people. And they look back and they say, I should have bought that house 10 years ago. I should have bought that commercial building. I should have invested in that storage facility. And over a 10-year period of time with leverage, because you're typically putting 30% down on investment property, the whole asset has appreciated maybe 50% or more. But that doesn't mean your investment appreciated by 50%. This means your investment appreciated by 150% because you leveraged it. You could 3 times your money in that period of time because of the power of inflation, of leverage, and then of tax deferral. That is an awesome thing. That's what got me excited about real estate. And if you get into commercial real estate, then you have a lot more options in terms of creative structures of financing the property with the owner participating, they're financing it, or the tax advantages that you can accelerate, or cutting off pieces of the property and selling them off and getting part of your capital back, or developing next door to part of your property and doubling the size of it. So if you like the game, then and you want to spend the time on it and focus and you're fine taking the risk, then be a full-time investor. That is it. And even if you have a job or a business, it's going to take time and energy and focus because the commercial real estate, even residential real estate, is a competitive game. And yes, you can buy a house each year and you can keep racking them up and you can hire a management company, but you're not going to get rich quick. And you're not going to get rich. I mean, it's going to take time. It even is a very, very conservative return over 10 years on these properties. But do it. Do something. Invest in something. And residential is a great asset class. There's nothing wrong with that. But the expectations I see are unrealistic many times, where once you factor in paying all the reserves and having to cover tenants trashing the place, leaving, advertising, management fees, improvements over time, like you're really not netting out as much as you thought, but the property is appreciating and you are creating equity over time and your tenants are paying down the loan, which is amazing. Okay, so anyone that's getting into real estate, buy a few rental properties, deal with it if you want to be a hands-on property owner, you want control. It will pay off. We all know that. You're probably watching this. I don't need to tell you that. But if it comes to a time when they are a pain and a nuisance and there is negative cash flow periods. So if you're not willing to reinvest back in the property, then don't buy that type of house. You have to sometimes feed it. There's negative cash flows, believe it or not. It's not all money making. So that is part of the game. Now, if you want to look at investing and being a limited partner, then it's about finding a relationship that works for you. Who is the sponsor that aligns with, number one, that you trust them first, and number two, that they have a lot of skin in the game, money, time, energy, team, experience. These are really, really important keys to having that person, that partner, manage your money in terms of being in that partnership and managing the property. And then, do they have an edge? Is there something about their product and their asset in the region that they're in that has demand, that people need this service, this product, and having the right expectations? Where as a passive investor, it's very rare you're going to make a 10 times X or 10 multiple on your money over a 5-year period of time. Those are old venture capital returns in the tech startup days, and those are far and few. It's realistic to 2 to 3 times your money in a 5-year period. That's an excellent return. That's over 20% average annual return if an investment partner can do that for you in real estate. And that's it. First rule that Warren Buffett shares about investing is do not lose money. Second rule is don't forget rule number 1, right? So fear and greed are not a good decision-making driver when making investments. If you're chasing returns, you're not investing, you're gambling, right? It's a gamble. I mean, I live in Vegas. That's exactly what people do. They think of some big pot of gold at the end of this bet that they're going to make, and it's a wish, it's a dream, it's a hope, and it very rarely works out. Investing is strategic, it's patient, it's discipline. That's what it is. Investment takes time. So finding that partner is critical, and that is, does their business plan make sense? Do they know what they're doing? Can they explain it to me clearly? Do they have a lot of skin in the game? Do they have a great team? Are they focused on an area, 1 or 2 areas that they know very well? And are they the jockey that's willing to die on the horse? Are they the ones that are going to grind it out and find a way to get through this thing because they are fully committed? And I want to get to a point in my career when I don't have to do all the work with my team. I love projects. I really do, but it is nice to be able to participate in someone else's great deal. And if they have inside access to deals and they can bring them to me, I'm happy to invest passively as long as they check all those boxes. And I'm hands off, right? I don't have to risk my debt. I don't have to risk my credit anymore. I just put up my money and I let someone else drive the show. And the other thing I would love to do is lend. So at some stage when I have another liquidity event, I will be lending money to property owners where I have a first position mortgage on their property, typically a commercial property that's a little bit bigger, and it could be $2, $3, $5, $10 million loan. And if I have a 65 to 70% loan to value on that property, and it's in good shape, and they have good tenants, and they have a good track record of running this type of property, that is a beautiful business model, especially if I can charge 9, 10% or more, plus a point or two up front. And lending is in a transition. I think there's going to be opportunities in lending in the next 3 to 5 years. So that is my future goals, being more of a passive investor. I love the projects, and I love real estate because I get the tax benefits. This is a key that I almost forgot, is that when being an active investor and a passive investor, I want the losses. And that's something to ask your partner with, is who's getting the real estate losses through the depreciation. And as a limited partner, it's great that you do. If you can get them, you can use them because they can carry forward. If you don't use them, they carry forward the next year. And if you have cash flow, you can offset it. So you can use those tax benefits to help you get higher returns so you can reinvest that money and compound your returns that much faster. So wrapping it up, the last few enemies of investors typically are inflation. So if you're not catching up with inflation and you're only getting a 4 to 5% return, you're really not getting a return at all. Inflation's through the roof. And if you are paying unnecessary fees for wealth management and they're just putting your money in the stock market or in some index fund, then why do you need them really? I mean, yes, there's sophisticated wealth managers that are very valuable. And I'm not saying tax advice or legal advice is not valuable. That's very valuable. But a wealth manager, to put your money in a Fidelity account, is pretty crazy for them to charge 1 or 1.5% of your cash each year as your wealth management fee. But there are a reason for fees. Now, real estate guys do charge fees. It's important that they charge them, but are they unnecessary or are they a necessary part of the transaction? For myself, people say, why do you charge an acquisition fee? Well, I got 5 guys that are hunting deals and they are hungry because they get paid mostly on commission. If I don't give them a percentage of that closing, they will not be excited and hungry to go out and find a deal because you have to be tenacious. That's how I built my career. You have to hit the phones hard. You have to get told no and be rejected continuously. People are rude to you. People lie to you. People will ghost you. You have no idea what's going on and you just got to be persistent. But those guys want that commission. They typically don't make much of a salary, so that's how they eat. That's how they feed their families. And there's other management fees that are very important. As long as the fees go to building a good business, a good operational system that improve the property, I have no problem with fees. Now, if it's getting sucked out and they're just taking cash for the sake of taking it, then that doesn't make a lot of sense. I think we should share in the upside. If I'm in a partnership, when the partnership wins, I win and they win. Yet getting the capital paid back first is critical. So when being a limited partner, I think one of the best structures there is out there is that getting your capital paid back first is a fair ask, right? Once the property sells, pay back the capital, pay back any other preferred returns or special arrangements on that capital, and then take the split. That is more than fair. So that is a crash course in active and passive real estate investing. It's the realistic expectations around real estate investing. I've been committed to it 20 years. I'm Jeremiah Boucher with Patriot Holdings. Would love to talk to you. If you come to Vegas, meet with me, meet with my office. They'll be holding some events this year on tax advantages, asset protection, protecting yourself from getting sued by anybody and your assets don't get taken away from you. I have a story about that with my father. And being able to make good strategic decisions, being patient, being disciplined, and having realistic expectations about what can I handle, what can I do to get a competitive edge to buy real estate, or who can I find that's going to help me acquire real estate and give me wealth and build my wealth over time. So thanks. I'll catch you. If you like this video, then check out my YouTube series on how to buy self-storage and mobile home parks. This will teach you a little bit more about the assets that I buy, what's good, what's bad, what makes a great deal, what isn't a great deal, and what's realistic, what are reasonable returns or what are exceptional returns when owning these assets, and then how would you acquire one or invest in one. So thanks. I'll talk to you soon. For more information on commercial real estate investing, go to patriotholdings.com. Thanks for listening to Finding Your Edge.